All right, John, I'll keep watching the waiting room. I just had two more people if you want to kick us off and
Okay,
get started.
great. Thanks, Megan, and thank you everybody for joining us. We're excited to do this. We wanted to get everybody together as we sort of close out the year to turn to the lending side of things to give you guys some important updates as to what's going on in the lending world as we wrap up 2024 and look ahead to 2025. So we're going to talk about interest rates. We're going to talk about the market. We're going to talk about new initiatives from different government organizations. We're going to talk about different loan programs, both at Meybohm Mortgage and also with the VA. So hope this will be informative for you guys. We've got Kim Sheltman with us, Amy Peace, Jeffrey Johnson, and John Mark Capers that are all going to answer some questions for us. So to get started, why don't we start with Kim? If you're there, Kim, you there? She may be on mute.
Can you guys hear me?
I can now.
All right.
Oh,
Happy holidays. Sorry, I
before
was
we get
muted.
started, yeah,
I
go.
think
Okay, good.
Megan
Kim,
put me on mute. I think she
I
wants me
know
to be muted.
she does that to people. Before we get started, I guess we'll cover just don't forget this Thursday evening. We'll all gather at the Crown Plaza over in North Augusta for our holiday party. So everybody, please come. Cocktail attire, spouses are encouraged and welcome. It's always a fun time, so please make sure to be there.
Wonderful.
All right, so Kim, I'll start with you. Let's start with everybody's favorite topic, interest rates. As you sort of look into your crystal ball, looking at rates for 2025, what are your, sort of what are you looking, what are you seeing, what are you predicting, expecting going into 2025?
Let's
Get your
see,
Metscape all
John. Let's see what it says. It says
Ask again later.
outlook good. How
Oh,
about
good.
that?
That's great.
Truly said that. I tried it earlier and I didn't like the answer, so that one was much better. So interest rates, I'm certainly glad to give you some kind of highlights of where the latest forecasts are. So I put together this slide just so I could have the latest, because it's been changing ever since obviously the election has happened. We've seen some changes, and I'll go into a little bit on that, as well as some of the inflation reports. The Fed obviously plays into this, but what you see on this slide is the latest forecast for going into 25 and 26. So you'll see three different forecasters that they really, kind of rely on, which is the Fannie Mae, the MBA, and the Wells Fargo 30-year fixed rate forecast. So you can pretty much see where they had forecasted at the end of 24 going into 25. You can also then see going in from 25 to 26. And so again, big picture is we're seeing a slow decline is what they're showing after having possible, and I think most of the first quarter blues are because of unknown policies in the new regime. So I think that's why you see a little bit of an uptick. And then you see a slow and gradual decline. And so clearly, we're looking in 2025, probably in the mid-6 range to low sixes. And then you're seeing going into 26, we're down to the low sixes, and some forecasts are showing high fives as far as the forecasts go. We had, prior to the election and prior to some of the employment reports and inflation reports, we had seen that they were projecting the Fed to have maybe as much as 5 interest rate decreases for next year. But again, the latest forecast is showing possibly 1 to 2. So again, nobody knows. These forecasters are just going obviously based on historical news. I think, what's going to factor into the rates is going to be the unemployment reports moving forward and inflationary pressures. So I hope that answered that, John, for you.
Yeah, it does. So we've got a Fed meeting in December. Any insight as to what you think they may or may not do there?
Yeah, I think the betting odds right now, which that meeting happens next Tuesday and Wednesday, 17th, 18th. So it'll be the final result will come out right around 2:30 next Wednesday. And betting odds are that we're going to see a 0.25% decrease. If it doesn't happen, which there's, always that chance, then the betting odds are that it will happen in the January meeting. So if it doesn't happen in December, it will be January, but widely expected for a 0.25% decrease by the Fed.
And Kim, what are some of the things the Fed is looking at when they make those decisions? I know you mentioned unemployment. What all are they looking at as they evaluate whether or not they're going to cut rates, keep them the same?
Well, so, they are still restrictive as they put out in their little synopsis that they do. They're saying that they are restrictive, but the inflation piece is the part that is the worrisome piece for the Fed. And, with there's talk of tariffs, et cetera, and some spending that could be inflationary. And because the Fed made the mandate that they wanted to have the 2%, level of inflation, and we've not quite got there. It's certainly gotten much better in the last couple of quarters, but because we've not gotten to that 2%, the concern is that with the increased spending and possible tariffs, that we may see some pricing pressure. So that is the main thing they are looking at. Secondarily to that would be the employment picture. It's showing slight softening, but still very vibrant on the employment side. So again, inflationary pieces that pertain to the employment are also worrisome. At the end of the day, it's all about inflation.
Got it. Okay. Thank you, Kim. All right, let's turn to John Mark. If you're there, I see you up there on my screen.
Good morning. Can you hear me?
Yep, we can hear you. Good morning.
Mhm.
It looks like, John Mark, there are some new conforming conventional loan amounts that were recently released. Can you tell us about those?
Absolutely. So, what a conforming loan limit is just a set limit by the finance housing, excuse me, the finance, um, the FNFA. They set a conforming loan limit every year, which typically moves up as the market moves up. And it is the cap for conforming loan conventional loan guidelines. So if you were to take out a loan above those limits, you would be in jumbo territory, which has stricter guidelines and usually a larger down payment amount. So we've seen an increase for 2025 up to $806,500 for a standard conventional loan. So that means a buyer can buy up to $806,500 in loan amount. That's not purchase price, it's loan amount in the year 2025, and it's currently active now too. And so they can put down a low down payment, in most cases down to 5% or even lower, up to that loan limit. If they go above that, then you start getting into the jumbo territory. So that's great news. It gives buyers a little bit more purchase power. It opens up the pool for more buyers to purchase in that range. FHA also increased theirs slightly up to 524,225. FHA goes by county, not a nationwide sweeping limit. But most of our counties in our local area are going off of the 524, 225 limit. So that's great news for buyers.
Gotcha. And so you said that's an 806,500 is what it's been increased to. And that's a
Correct.
loan amount, not the purchase price, right?
That is the loan amount. So you can essentially buy above that and make up the difference in down payment and still be below the conforming loan limit. But it makes, it allows buyers to purchase up to that loan amount without having to go into jumbo territory where you have additional guidelines, stricter guidelines to qualify. So anything below that loan limit is going to be a standard conventional loan with Fannie Mae and Freddie.
Got it. Okay. John Mark, it looks like Meybohm Mortgage has got some exciting affordable lending options. Can you explain some of those options for us?
Yeah, absolutely. And I went over both of these briefly in our most recent sales meeting out here in Evans. But these are two programs we're pretty excited about. One is called our ResSource program, which is unique to Meybohm Mortgage. We're able to offer a grant of up to $5,000 in down payment assistance on a conventional loan. So if a buyer comes along and qualifies for a low 3% down payment conventional loan, we can offer them up to $5,000 as part of their down payment. So it covers 2% or 5,000, whichever is lower. So that's great news. That means that the buyer actually only has to bring 1% of the purchase price to closing as their down payment, rather than 3% of bringing 1% and we bring the rest. So it's a great product. It's a conventional loan product. It has a fairly reasonable credit score to qualify for. So it's a great program. And that money, what makes it unique is that money is not repayable. So that buyer gets that $5,000, puts it towards their down payment, and they don't have to pay it back to us. So that's great news. And we have another program called our Dream Start program. If you'll move to the next slide, I think there should be a slide on that one as well. Here's some additional qualifications for the ResSource program. As I mentioned, doesn't require a huge credit score to qualify, and the buyer only has to contribute up to 1% of the 1% of the transaction for the down payment. Our other program we're excited about is our FHA Dream Start. This is a FHA loan. Anyone who qualifies for an FHA loan can qualify for this program because there's no income requirements on it. So typical FHA loan requires a 3.5% minimum down payment. So FHA Dream Start offers a second lien that the buyer can use to fund their 3.5% down payment. They can even go up to 5% of the purchase price if they want to, which will cover some additional closing costs for prepaid items that they're responsible for. So no borrower contribution required. That essentially means that this is 100% financing. Low credit score required, only 620. So most buyers that are qualifying for an FHA loan are also going to qualify for this. It's got eligible property types of 1 to 2 unit properties. So if you're buying a single family home or a duplex, that is eligible for this program. Also condominiums, which we don't get a ton of in Augusta, but we do see a condo every once in a while. Modular homes and HUDs, which is going to be your new construction neighborhoods. So it's a great program that's unique to FHA. Most other down payment assistance programs are like, for example, Georgia Dream. Most of those are repayable, just like this, but you have a lump sum of equity that the buyer's having to pay back after closing if they sell the house or refinance. In this case, they're having a low payment second lien as part of their financing. So they're able to finance up to 100% of the purchase price.
Right. I appreciate that, John Mark.
Yeah, absolutely.
Amy, let's turn to you, Amy. If you're Amy Peace, if you can hear me, you might be on mute.
Hey there.
Hey, Amy, how are you?
I'm good. How are y'all?
I'm good. I'm good. So I heard that Meybohm Mortgage is sponsoring a company workshop with a great speaker concerning VA buyers. Can you give us any more specifics on that?
Yes, we are finalizing all the details. The date will be January 29th from 9 to 11 a.m. and the location is to be determined. We are so excited to welcome a nationally recognized VA speaker to assist the Meybohm agents on all of the important specifics surrounding the VA buyer.
Great. Amy, I know you've worked with some VA buyers in the past. What are some challenges that come with working with VA buyers?
I mean, there aren't really any challenges. VA loans are my favorite loans to do, to be honest, because there's no money down in most cases, and it's very streamlined process. VA loans are pretty standard as far as the guidelines, and they're just they're my favorite ones to do.
Yeah, that's great.
When
All
I
right, we'll
think,
bring in Jeffrey. We'll come back to you in a second, Amy. Jeffrey, if you're there. We
Yes,
get asked
sir.
we get asked a lot. Does Meybohm Mortgage do any outside of the box financings? Can you answer that? And if so, maybe explain what some of those might be.
Absolutely. Yeah, I think that that is a common question that any loan officer gets multiple times because there's obviously people that come through that don't qualify for the traditional lending product like a conventional loan, VA, FHA, USDA, all of those inside of the box products that we're also familiar with. So it's important that lenders have those outside of the box options. And we've got something called the Smart Series. And a couple of things that I want to point out about the Smart Series is that these portfolio loans are underwritten in-house and also funded by us. And those two things are important because once you start getting outside investors involved and other people involved in the underwriting process, oftentimes that introduces credit overlays that really take away the flexibility of products like these. So these products are very flexible. And just to kind of break down these products just a little bit more, the Smart Series is broken up into three key non-QM loan types, and they are Smart Self, Smart Edge, and Smart Vest. So just really quickly, I'll touch on these so we can keep this party moving. Smart Self is ideal for the self-employed borrower. And in that suite of products, we would be looking more at their bank statements for income versus maybe someone who wrote off a lot of business expenses and their net profit on their tax returns does not qualify for traditional financing. So we may utilize their bank statements to calculate their income. Smart Edge would be people that maybe fall just outside of the traditional mortgage qualifications. Maybe someone who had a bankruptcy or foreclosure a little more recent than a traditional loan would allow. We may go that route. Lots of jumbo offerings in that section as well. And then lastly, the Smart Vest would be for real estate investors. So buying an investment property for business purposes. So it might be easier to tell all of you who ask us, hey, what products do you have? In some cases, it's easier to tell you what products we don't have because there aren't many people that we can't help, assuming they meet the qualifications. That's all I got.
That's great. Amy, we'll jump back to you real quick. I know I've gotten asked this before, but tell me about some products that are available for clients that allow them to access equity from their primary home while maintaining the low interest rate they've got on their first mortgage. I know that's an issue that a lot of home buyers are facing as they look to buy new houses.
Yes, we have a product called the HE loan. It's different from any other type of HELOC or home equity loan that's out there. And all the money is funded at closing, and the payment is amortized over 30 years with fixed payments being made to both principal and interest. The minimum we do is $50,000. And this is an easy way for borrowers to access their equity without having to mess with their interest rate on the first mortgage.
Got it. Got it. That's great. Go ahead. Somebody trying to say something? No. Okay. Jeffrey, we'll slide back to you. You're our South Carolina Aiken guy. We heard there are some changes coming from the housing department on their bond loans. Can you provide some insight?
Yeah, absolutely. SC Housing is something that I've been doing for a long time, and they roll out changes sometimes annually. And I've seen the amount of assistance go up, since it was, I believe, $4,000 to $5,000. And now the latest change is it's going from $8,000 to $10,000 in assistance, which is $2,000, as you all know, when purchasing a home can, for lack of a better phrase, do a lot of damage, can really help them, can knock out a chunk of closing costs and really bridge that gap between what they need and what they have. So that's one of the biggest changes, is the increased amount from 8 to 10,000. Another one that I think is even bigger, because in my past of doing these, I have noticed that they calculate, SC Housing has historically calculated household income. What do I mean by that? So if I were to apply for a mortgage and I'll need SC Housing assistance, I've got the credit score and I've got income. My wife would also like to be on the loan, but maybe her credit score doesn't meet the minimum guidelines, so she can't be on the loan. Well, historically, SC Housing would say, well, even though your wife is not on the loan or on the mortgage application, we have to count her income towards our income limit. And that boxes a lot of people out of the program because they exceed the household limit. The exciting news is now, as of, I believe, December the 16th, when the increased limit happens, they are only going to count the income of the person on the application. So they can get this and not be boxed out of the program. I think that's an exciting change. I can't tell you how many people have been on the outside looking into this program because their household income limit exceeded SC Housing's limit. So those are the two big changes and should help a lot of people.
That's great. Kim, I'm going to jump back to you. As we move into 2025, what have you seen as some hurdles maybe to the mortgage industry in 2024 that may be getting better or easing a little bit as we get into 2025?
Yeah, I think that, Megan, if you could flow back to maybe, I think I put even, I was reading this actually this morning, and so I thought this was some good information as well, right there. This is something that just came hot off the press, about the survey that Fannie Mae puts out there to kind of survey and see how people are feeling about purchasing a home. So I figured it's good for not only mortgage, but for your side, certainly the real estate side. And so their home purchase sentiment index increased 0.7 points in October. The interesting piece about this, to me, again, it's the highest level since February of 22. So, again, for everything that we do between mortgage and real estate, title, people are starting to feel better about the market in general. I think people are honing into that rates are not going to go back down to 3%. They're getting more comfortable with the, high 5, low 6s. So, although there are challenges, certainly in any market, I also feel extremely optimistic with, again, I've shown that rates are going to be slightly, dropping over, the next 12 to 24 months. But at the same time, consumers are feeling better about making a purchase for a new home or existing home. And putting those two together, to me, we just got a Christmas present under the tree, right? This is good news for us. And so I couldn't be more happy to be in this side of the business on the mortgage and real estate side. So good things coming for us, John. I don't see there, again, we talk about challenges. There's certainly we have, FICO, they're still fighting on the FICO score front, trying to kind of revise how that is determined. I don't know if that'll be in the next 2 years that'll come out. I think trigger leads are something that has been problematic on our side, where we, order a credit report and the credit bureaus sell to, thousands of mortgage companies, and then our clients end up getting, hundreds of calls from lenders. That is in a bill up there sitting in Washington. I don't know if Julie has any update on the trigger leads, but I do know that that is still out there active. And there was some revisions made to the bill, I believe, and that's the last I heard. So those are probably the biggest challenges, but I see the optimism for, again, having people feel good about making a purchase, knowing that rates are slightly on the decline, I think is a recipe for success for us.
Great. John Mark, I'm gonna come back to you. I know that you and Jeffrey and Amy all each do some new construction. Is there anything for our new construction agents that you want to highlight going into 2025? I know we've got a bunch of lots coming on the ground. How are new construction loans maybe a little bit different from your traditional loans, and any keys that you want our agents to know about new construction loans?
Sure. So, one major thing that's different about new construction in most cases is that as the home's being built, your buyer's going under contract well in advance of the closing date. So some things to keep in mind is it's never too early to have your buyer pre-approved. And we will stay in touch with them, keep updating documents through the underwriting process with them. We're a little bit more at the mercy of the market on new construction. So if you have a 6-month contract, say, for example, in Whispering Pines, somebody goes under contract and the home won't be done for 6 months. We're going to certainly keep an eye on the market, but it doesn't always make sense for the buyer to lock in their interest rate up front. Once we get to about 90 days out, then we start sort of looking at the market and when it might make sense for them to lock in their rate. But additionally, one of the perks of new construction is a lot of times you'll have builders offering incentives. And we as a lender can also offer some incentives for the buyer to purchase a new construction home for one of our preferred builders in our neighborhoods. And that's something that the buyer can take advantage of to either lower their closing costs. They have attorney's fees, they have appraisal fee, they have some other fees that they'll have to pay at closing that can dig into. But they can also use it to lower the interest rate if they want. They can use it to purchase a buy down on the interest rate if they have the cash to cover their closing costs, and instead want to use those incentives to lower their rate. That can put them in a much better position over the long term of their mortgage on that home. So some great advantages to new construction, and it's also a new home. So, yeah.
Perfect. Anybody, I know I've been dominating the conversation, asking the questions. Anybody out there have any questions before we ask a couple more and then wrap up?
Hey, I don't have a question. I'm just going to let you know that I upload, it wouldn't let me upload the PDF. So I just put the link for the advocacy wins from NAR. So if you look at the regulatory, you'll see an update on the lending piece. But while I'm unmuted, I'm looking at the list of people on this call today, and I'm seeing a lot of agents who I know have partnered with our mortgage experts and had buyers that have done business with them. And I just want to thank y'all for doing that. But truly, Jeffrey, Amy, and John Mark, y'all have saved a lot of deals, and we are grateful for you, and just appreciate you very much. Just wanted to say that out loud.
Appreciate that,
Ditto, Julie. Thank you.
Yeah, thank you for posting that link. Anybody else have anything you want to ask our distinguished panel here?
I have a question.
Sure.
Is there anything that we need to know or that has been or is being discussed that has to do with agent compensation and mortgages?
I'm glad to take that. It has been the biggest lack of anything that I've ever seen. Does that make sense? I think we were all preparing. We're like, oh my God, what are we going to do? These documents, how are we going to qualify them? Blah, blah, blah. And I don't know, certainly John, Mark, Jeffrey, if you want to even jump in, Amy, it's been the biggest nothing burger that I've seen, on our side.
I agree with that.
Would that be, yeah, I mean, I've, talked to folks around the country, and it's been the same, not only just with us. So that's why I wanted John, Mark, or Jeffrey or Amy to jump in, because I don't live it every day. But I will tell you, just from across the country, I'm hearing from our other joint venture partners that, again, big nothing burger. So
Yeah,
we'll take
it's
that as a
been-
positive, right?
Right. Yeah, it's been business as usual, I think, for us. And I think at the beginning of all this, when all the news had broken that these changes were gonna take place, my gut was telling me that, hey, this won't affect our side that much. It'll be business as usual. And I'm not right all the time, so don't hear me say that. I just happened to be correct in my intuition this time. It really hasn't been much of a change for us on our end. We get a lot of questions about it because I think there's just been a lot of stuff in the media and online that has scared people and confused them, and it's caused them to doubt. But we were able to have those conversations and ease them. So it's been good on our end.
Excellent. Thank you so much. I just continue to get questions from agents as I help them make sure they fill out the forms properly. And I just want to make sure I'm up to speed on that. Thanks.
That's great. Thank you, Janet. Anybody else have anything they want to ask?
John, I was just going to quickly echo what Julie said and just say thank you to Jeffrey, Amy, John, Mark, Kim from our mortgage company for doing this, and just encourage all of you. Let's give these guys a chance. Show you what they can do and what they're capable of. They're our family, our mortgage company, and let's support them. But thank you for taking time to do this. Very helpful. John, thank you for moderating and doing such a great job. You are so gifted at moderating these things, and appreciate you doing that. So thanks everybody for jumping in and supporting this morning.
Yeah, if you moderate, you don't have to answer any questions. That's the that's what I like about it.
Hold on, John. I might have a question now.
Yeah, absolutely. What's your
I'm
question?
gonna ask John Cates.
Sure.
What's your outlook for next year?
Yeah, we're optimistic. We just had this conversation as a senior leadership team just the other day, just yesterday. And I think that a lot of what we've seen in terms of headwinds, in terms of inflation, interest rates, inventory, all of those things, uncertainty about the election, we feel like 2025 is probably going to continue to be a little slow to start the year. We've had a little slower November and December, but we are really expecting February, March, and into the spring and summer to be much better than it's been in 23 or 24. We just see so much pent-up demand. We think as rates get in the mid sixes, like you said, it's something that people are starting to get comfortable with. realizing that it's not going to dip back down into the threes anytime soon. There's just a lot of pent-up demand for people to move. Inventory came back up a decent amount in 2024. I think that's a headline that hasn't been a headline. We've seen the number of houses in the market come back up, so I think there's an increase in supply, and there's a lot of demand. And then the other thing too is there were over 830 houses that we had in our inventory that existed before the hurricane. And so you've got, 830 households that are looking, that owned homes, that are going to be looking for homes as theirs either get repaired or as they just take the insurance money and want to buy something new. So there's all of this pent up demand, and we think that as rates come down a little bit, it's going to turn into a quote unquote more normal year. What I mean by that is we haven't really had regular seasonality since 2019. We had, the COVID years where it was kind of crazy the whole time. Now we've kind of had some funky seasonality that we don't normally see. I think we're going to get back to more of a normal seasonality in our business starting in 2025. So we're optimistic. We're projecting a 10% increase in both volume and units. I think that that's probably a pretty good forecast. And again, we think people are going to start getting busy the early part of the year now. The election's behind us. And now that a lot of the uncertainty with where rates will go, all the graphs I'm seeing, Kim, are mirroring the one that you sent, where we're going to see more and more rate cuts. It's not going to be nearly as aggressive going down as it was going up. But I think that a lot of people will say, I don't, necessarily need to know if the rate's going down or going up. I just need to know where it's going. And so I think as the Fed becomes less active than they have been over the last 2 or 3 years, that creates a lot less uncertainty. And when there's more certainty in the marketplace, people tend to transact more often. So that's kind of what we're expecting and seeing as we move into 2025. But I appreciate everybody's time. This was a very well attended. One of the great things I like about having Meybohm Mortgage here is these guys are resources. So to be able to do this not only now at the end of the year, but also in sales meetings, it's just great to have you guys as resources and experts, because I know that I get asked a lot about interest rates, and I'm sure that our agents, their clients, ask too. And I'll close with this. Not to single out John Mark, but I did just get this yesterday from one of our great agents. Just wanted to let you know that John Mark has been nothing but amazing. He's really turned into my primary lender recommendation. He answers calls, explains things well to clients, and comes to closings. So I did just get that yesterday from one of our agents, and thought I'd highlight one of our loan officers, John Mark, Amy, and Jeffrey, all have done a great job. And not only do they do a good job, but they're responsive, which I think is important. And they're really a part of our family. So I'm just pleased with how this is going. And again, they're here to be a resource for you guys. So thank you, everyone. Hope that y'all had a great Thanksgiving. Hope that you have a great Christmas coming up. And we'll continue to let our loan officers send you guys updates as we move into 2025. Thanks, everybody.
Thanks.
Bye, everyone. Thank you.
Take care.
Good to see everybody.
Merry Christmas.
Merry Christmas.